What's going on, dividend chasers? It's the Dividend Bloodhound here, and welcome to another investing episode. In this episode, I'm going to talk about three of my top 3 tips for investing in the stock market. I'm not alone in this video though. David at from the Pretty Penny Club channel is also going to give his 3 stocks in another concurrent video over on his channel. Say hello, David.
Hello everyone, my name is David. My channel is all about personal finance and helping you reach your financial goals through investing, frugal living, passive income, generally making your money work harder for you. So if that sounds like something you'd be interested in, I would love to see you on the channel. So thanks to the Dividend Bloodhound for having me on and giving me an opportunity to talk to you. It's been great fun putting together these tips for you. I hope you get something out of them, and all the best with your investing.
That was David there. Do make sure that you go and check out his channel. I will post a link in the description below so you can click a link to his channel. It's an up and coming channel. Please do show him some support, the same support that you've shown me. That would be absolutely fantastic. Anyway, without further ado, I'm going to plug my own channel now. If this video does bring you some value, please hit the like button in the corner over here, or even if you're brand new here, please do subscribe and hit the notification bell as well so you get notified of brand new content that I release just like this. I'm also open to collabs with any other YouTube creators that are out there. That being said, let's get into the 3 top tips we're going to look at, and I will see you on the other side. Roll the intro. Hello again guys, welcome into the video. So my top tip number 1 is do not get emotional over your stocks. Do not get attached to a company just because you like what they do, or even buy a company in the first place because you like what they do. Just because you like the product doesn't necessarily mean their fundamentals are great and that makes it a great investment. Always remain calm. Use your head, remain calculated, and use your brain, not your heart, when investing, because it is important. Otherwise that will cost you a lot of money. If you stay in it just because you think your heart's in it and you love the company and you don't pay attention to the actual fundamentals of the company and where the company's going and the sector that it's in, then this could hit you in the pocket and really hamper your investments. Warren Buffett has that age-old saying where he says, "Be greedy when others are fearful," and that is so important. You need to take advantage of the stock market when it is at lows and people are exiting. The actual risk involved in investing actually gets higher as the stock price goes higher. If a new company is reaching record highs, for example Apple and Tesla recently, then there is a good chance that if you buy in at that actual peak, then it will come down from there and you will lose money, and you'll have to wait in the longer term for the price to go back up, when really you could just cool your emotions, keep calm, play patient, which is another one of my tips coming later, and just wait and see what happens. You don't have to get involved just because you think the stock price is going to the moon. Remain calm, remain calculated at all times. Tip number 3, and I can't really stress this enough: do your research. You have to have a look in these companies. No, that doesn't mean that you just have a look at the dividend yield and go, oh yeah, it pays a 4 and a 5% dividend yield, I'll just plow into that with my money. Don't do that. You have to dive into these companies. You have to have a look past the pretty looking logo, the headlines, and the dividend yield. There are so many metrics out there for you to look into when you are researching a company. You can look at the actual assets the company hold, its revenue, has it been increasing year on year? What's their debt to assets ratio like? What's their compound annual growth rate? What is the dividend growth rate? Are they growing it year on year? Is it double digit growth? Have they been paying a rising dividend for 10 years? 15 years? Are they a dividend aristocrat? Are they a dividend king? These are key things that you should look into, as well as the balance sheet and knowing whether the company is profitable or not, as to whether you can make a sound investment decision or not. Don't just jump on the bandwagon. If you see loads of people talking about something, it's best not to do your research before you get involved yourself. Now this one goes without saying really, don't fall into the dividend yield trap. I fell into it myself not so long ago when I first started investing with Occidental Petroleum. They had a nice double-digit yield, and then this health crisis happened, and now that yield has gone to absolutely nothing, and I'm stuck with a company that's now halved in value and has no dividend. It's probably my worst investing decision so far. Again, I couldn't predict a global pandemic, but still I was yield chasing a little bit. You need to not do exactly that. Just because there's a great big yield on offer doesn't necessarily mean the company is financially healthy. They'll lure you into the gingerbread house with that nice big fancy yield, and you start thinking, oh, within a few years I'm going to get the cost of the stock back really quickly, whereas Coca-Cola is only paying a 3% yield. Yes, there's a reason for that. They lure you in, and then exactly what happened to me will happen to you. You get lured in, you get stuck with an investment, and now you either sell it at a loss or you keep it for the long term, and it's not paying a dividend at the moment. I don't know when that share price is going to recover, so that's going to be like a stain on my investing portfolio for quite a while. So do bear that in mind. It is so important that you don't fall into that trap. Last little add-on for the do your research section is set your own rules and stick to them. Don't be goaded by anybody else. But from investing forums or YouTubers, other YouTubers, the news, whatever it is. If you have your own set of rules set up for where you want to invest in a company, or a price point that you're happy with, that you won't invest until it gets low enough for you to invest, then stick with that. You've done your research, back yourself and go with it. Obviously, you need to be realistic with where you set your price point. There is no point at the moment in trying to set a price point for Apple at $200 until it actually does its stock split, because that is at the moment never going to happen. When the stock actually splits, you'll be able to pick up a share for $100. And then a realistic example of that would be you set a price point of you want to pick up Apple shares at $97 a share. That is a realistic price point to get in at. There is no point in being completely unrealistic with the price point that you set yourself, but do stick to your rules. That is another key point. And the final tip in this little video is be patient. Rome wasn't built in a day, and neither will your dividend or growth portfolio. You have to allow some time for your investments to grow. You are not going to become a multi-millionaire or make hundreds or thousands of pounds overnight. It just doesn't happen. It's not part of how we do things in the stock market as dividend or growth investors. If you want to do that sort of thing, get yourself a day trading account on Trading 212 or Robinhood. Please do your research if you do that, but that is where quick money can be made. You can easily turn a very big profit very quickly by day trading, and day trading properly and well. Word of warning there though is, even on Trading 212 CFD's own website, 76% of people that have accounts with them lose money. So you are already have the odds stacked against you when you are going down that route. I much prefer to sit with my dividend growth stocks and dividend paying companies and play the long game, where you don't have to panic because you haven't done a little bit of research, or you've left a position open too long and you've lost a load of money on it. Statistically, you are most likely to lose money on day trading accounts than you are in dividend investing. My strategy, and a strategy that I believe can work for absolutely anybody, is to buy and hold value companies. You have to be patient. This sort of thing takes years to actually happen and start compounding. But if you buy dividend kings, dividend aristocrats, value companies that have a proven track record of paying their dividends and growing them year on year, then you will get to your compounding level very, very quickly, and far quicker than if you try and trade your way up or you keep chopping out these stocks every now and again. Just back your research, get into the proper good companies good value companies, and then all you have to do is just sit on them and wait and let the dividends roll in, add to them and buy another share with them dividends, and then so the process continues. Every quarter you get to buy a little bit more, a little bit more, a little bit more, and then fast forward 10 years, you've amassed a serious amount of wealth. You just have to be patient, let time do the work, and then you don't have to work so hard yourself. Also, don't panic sell if there is a 5% drop in the share price, because all you'll do there is lose money. If every time a share price fell 5% you sold it, you would very quickly find yourself losing money. Just hold your nerve, hold your patience, and just wait. And the price will usually, if it is a good value company, will recover back to where it was or rise higher. Obviously, if there is a major incident with the company, for example, going back to the Deepwater Horizon crisis that took hold of BP and it got them, they suspended their dividends for well over a year, and the dividends were cut or not very high for a subsequent year or two after that. And that is a major event. And then at that point, as an investor, you have to take action. But if the price just dips because 5% because they had a less than expected earnings, they missed their revenue or they missed their EPS or whatever that is, then you have to back that company in the long term. Okay, this quarter they've taken a slight dip, but what happens if in the next 3 quarters, when they recover from that and they grow their revenue for the next 3 quarters? You've sold out at a 5% loss, and now the share price is 15% higher, and all of a sudden you've lost money for no reason other than not being patient. And that just about wraps us up for this episode. A quick recap then. 3 top tips. Do your research, be patient, and don't get emotional over your stocks. And then the little subsidiaries among that I've also mentioned. Feel free to go back over the video as you wish to check them extra comments out. But them are the big 3 things that I wanted to get across in this video. Also, a last shout out to David over at Pretty Penny Club for collabing on this video. It's been great. It's been my first collab where I've actually had somebody else properly into my videos and get in touch properly, and we've actually matched up our content. I've really enjoyed doing this, so yeah, I've really had a great time. And if you would like to see more content, please hit the subscribe button if you're brand new here, and if you've really found some value in this video, do please hit the like button. That helps me and the channel out massively. That being said, there's nothing left to say except goodbye, and I'll see you in my next investing episode, hopefully. Bye bye.